Question 1. In Kansas, what is the minimum free look period for a new life insurance policy? A. 5 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. The free look period allows a policy owner to review a new life insurance policy and return it for a full refund of premiums paid if they are not satisfied. In Kansas, the minimum statutory free look period is 10 days, starting from the date the policy is delivered. This provision is designed to protect consumers, giving them ample time to ensure the policy meets their needs and understanding its terms without commitment. Remember this 10-day period as a common standard for many individual insurance policies, providing a crucial consumer safeguard. Question 2. A licensed producer in Kansas offers a client $100 cash back from the first year's commission as an inducement to purchase a life insurance policy. This action is considered A. Twisting. B. Churning. C. Rebating. D. Misrepresentation. Answer: C. Rebating. Rebating occurs when a producer offers any valuable consideration or inducement not specified in the policy, such as a portion of their commission or cash back, to encourage a client to purchase insurance. This practice is illegal in Kansas and most states because it can lead to unfair competition and potentially encourage policy purchases based on incentives rather than suitability. Always remember that any financial inducement or gift not clearly stated in the policy itself is likely an illegal rebate. Question 3. Under a life insurance policy in Kansas, if the insured commits suicide within a specified period from the policy's issue date, what is the insurer's typical liability? A. The insurer must pay the full death benefit. B. The insurer will return the premiums paid, without interest. C. The insurer will return the premiums paid, plus interest. D. The insurer will pay nothing. Answer: B. The insurer will return the premiums paid, without interest. Life insurance policies typically include a suicide clause, which states that if the insured commits suicide within a certain period, usually 2 years, from the policy's issue date, the insurer's liability is limited to a refund of the premiums paid. This clause is designed to prevent individuals from purchasing life insurance with the intent of committing suicide shortly thereafter to provide for their beneficiaries. If the suicide occurs after this initial period, the full death benefit would generally be paid. Question 4. In Kansas, which of the following statements is true regarding a life insurance policy's grace period? A. It is typically 10 days for all policies. B. It is usually 31 days, during which the policy remains in force. C. It applies only to term life insurance policies. D. Premiums accumulate interest during the grace period. Answer: B. It is usually 31 days, during which the policy remains in force. A grace period is a stipulated amount of time, typically 31 days in Kansas for individual life insurance policies, after the premium due date during which the policy remains in force even if the premium has not been paid. If the insured dies during the grace period, the death benefit is usually paid, less any unpaid premium. This provision protects policy owners from accidental policy lapse and ensures continuous coverage. Always advise clients to pay premiums within the grace period to avoid potential policy termination. Question 5. All of the following are standard non-forfeiture options available in a whole life insurance policy in Kansas except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan. Answer: D. Automatic premium loan. Non-forfeiture options are benefits available to a policy owner who stops paying premiums on a whole life policy that has accumulated cash value. The 3 standard non-forfeiture options are cash surrender value, receiving the policy's cash value, extended term option, using cash value to buy a single premium term policy for the full face amount for a limited time, and reduced paid-up option, using cash value to buy a single premium whole life policy for a reduced face amount. An automatic premium loan is a policy rider that uses the policy's cash value to pay overdue premiums and is not a non-forfeiture option itself, but rather a way to prevent a policy from lapsing. Question 6. A life insurance policy in Kansas contains an incontestability clause. This clause generally prevents the insurer from denying a claim based on misstatements in the application after the policy has been in force for how long? A. 6 months. B. 1 year. C. 2 years. D. 3 years. Answer: C. 2 years. The incontestability clause prevents an insurer from voiding a policy due to misstatements, concealment, or fraud in the application after the policy has been in force for a specific period, typically 2 years in Kansas. This clause protects the beneficiary by ensuring that, after this period, the insurer cannot dispute the validity of the contract, even if they discover material misrepresentations. The primary exception to this rule is impersonation or lack of insurable interest, which would still allow the policy to be challenged. Question 7. According to Kansas law, who must sign a life insurance application? A. The producer and the applicant. B. The applicant and the insurer's underwriting officer. C. The producer only. D. The applicant only. Answer: A. The producer and the applicant. In Kansas, as in most states, both the applicant and the producer must sign the life insurance application. The applicant's signature confirms that they have read the application and that the information provided is true to the best of their knowledge. The producer's signature confirms that they witnessed the applicant sign, that the application was filled out completely and accurately based on the information provided by the applicant, and that they solicited the business. This dual signature ensures accountability and helps prevent fraud. Question 8. In Kansas, if a policy owner wants to assign their life insurance policy to a third party without giving up all rights of ownership, they would typically use which type of assignment? A. Absolute assignment. B. Collateral assignment. C. Irrevocable assignment. D. Per stirpes assignment. Answer: B. Collateral assignment. A collateral assignment is a partial and temporary transfer of ownership rights, typically used when a policy owner pledges the cash value of a life insurance policy as collateral for a loan. The assignee, e.g., a bank, only has rights to the policy up to the amount of the outstanding loan. Once the loan is repaid, the assignment is released, and the policy owner regains full rights. In contrast, an absolute assignment transfers all rights of ownership permanently. Question 9. An agent's license in Kansas is considered to be inactive if the agent fails to: A. Complete required continuing education. B. Pay annual renewal fees. C. Sell a minimum number of policies. D. Maintain an office in Kansas. Answer: A. Complete required continuing education. A key requirement for maintaining an active insurance producer license in Kansas is the completion of specified continuing education (CE) hours within the biennial renewal period. Failure to complete these CE requirements, along with failing to pay renewal fees, can lead to the license lapsing or becoming inactive. This ensures that agents stay current with industry changes and regulatory updates, benefiting consumers. Always keep track of your CE hours to ensure your license remains active and in good standing. Question 10. A policy owner in Kansas allows their whole life policy to lapse due to non-payment of premiums. Which of the following options may allow the policy owner to put the policy back in force? A. Conversion. B. Reinstatement. C. Annuitization. D. Twisting. Answer: B. Reinstatement. Reinstatement is the process by which a lapsed life insurance policy can be put back in force. To reinstate a policy, the policy owner typically must pay all back premiums with interest, prove insurability, often by passing a new medical exam, and repay any policy loans with interest. This option is usually available for a limited time, commonly up to 3 or 5 years after lapse, and it allows the policy owner to retain the original policy's issue age and cash values. Question 11. Which of the following statements regarding the advertising of life insurance policies in Kansas is false? A. Advertisements must be truthful and not misleading. B. Illustrations of policy dividends are guaranteed amounts. C. Advertisements must clearly identify the insurer. D. Terms like investment must be used carefully to avoid misrepresentation. Answer: B. Illustrations of policy dividends are guaranteed amounts. Illustrations of policy dividends in life insurance advertisements are never guaranteed amounts. Dividends are a return of excess premium and are based on the insurer's actual mortality, interest, and expense experience, which can fluctuate. Kansas regulations, like those in other states, require that any illustrations of dividends must be clearly labeled as non-guaranteed and based on current assumptions. This prevents consumers from making purchasing decisions based on potentially misleading expectations of future returns. Question 12. A Kansas resident purchases a variable life insurance policy. Which of the following statements is true regarding the regulation of this policy? A. Only the Kansas Insurance Department regulates it. B. Only the Securities and Exchange Commission, SEC, regulates it. C. It is regulated by both the Kansas Insurance Department and the SEC. D. It is not regulated by any state or federal agency. Answer: C. It is regulated by both the Kansas Insurance Department and the SEC. Variable life insurance policies are considered both insurance products and securities because their cash value and death benefits can fluctuate based on the performance of an underlying investment account. As such, they are regulated by two authorities. The Kansas Insurance Department oversees the insurance aspects, such as licensing and policy provisions, while the Securities and Exchange Commission, SEC, regulates the investment aspects and ensures compliance with securities laws. This dual regulation ensures consumer protection on both fronts. Question 13. A policy owner in Kansas wishes to exchange their existing life insurance policy for a new one with a different insurer. The producer involved in this transaction must provide the policy owner with A. Policy summary. B. Buyer's guide. C. Notice regarding replacement. D. All of the above. Answer: D. All of the above. When a life insurance policy is being replaced, Kansas regulations require the producer to provide the applicant with several important documents. These include a notice regarding replacement, which explains the potential disadvantages of replacement, a buyer's guide, which provides general information about life insurance policies, and a policy summary, which details specific information about the new policy being applied for. These requirements ensure that consumers are fully informed before making a decision that could be detrimental to their existing coverage. Question 14. Which of the following is considered an unfair trade practice in Kansas when marketing life insurance? A. Requiring a medical exam for underwriting. B. Denying a claim based on a valid exclusion. C. Engaging in defamation against another insurer. D. Offering a policy with a cash surrender value. Answer: C. Engaging in defamation against another insurer. Defamation is an unfair trade practice where an insurer or producer makes false or maliciously critical statements about the financial condition of another insurer or producer. This action is illegal because it can harm the reputation and business of competitors and mislead the public. Insurance regulations aim to promote fair competition and ensure that consumers receive accurate information without undue influence from false negative portrayals of other companies. Question 15. In Kansas, if an insured misstates their age on a life insurance application, and this is discovered after the policy has been issued, what is the typical result? A. The policy is immediately voided. B. The death benefit is adjusted to reflect what the premium would have purchased at the correct age. C. the premiums are increased to the correct rate, retroactively applied. D. The insurer must pay the full face amount regardless of the misstatement. Answer: B. The death benefit is adjusted to reflect what the premium would have purchased at the correct age. The misstatement of age or sex provision in a life insurance policy addresses situations where an insured provides incorrect age or sex information on the application. Rather than voiding the policy, the insurer typically adjusts the death benefit to the amount that the premium paid would have purchased at the insured's correct age and sex. This ensures fairness, as actuarial calculations for premiums and benefits are heavily dependent on accurate age and gender information. Question 16. The Kansas Life and Health Insurance Guarantee Association provides protection to policy owners in the event an insurer becomes insolvent. What is the maximum death benefit protection per life, regardless of the number of policies held with the insolvent insurer? A. $100,000. B. $250,000. C. $300,000. D. $500,000. Answer: C. $300,000. The Kansas Life and Health Insurance Guarantee Association was created to protect policy owners, beneficiaries, and annuitants against financial losses due to the insolvency of an insurer. While the exact limits can vary by state and policy type, for life insurance death benefits, the typical maximum coverage in Kansas is $300,000 per life, regardless of how many policies that individual held with the insolvent insurer. This cap ensures that a safety net exists without creating an excessive burden on the solvent insurers who fund the association. Question 17. Which of the following is a key characteristic of a participating life insurance policy in Kansas? A. It does not accumulate cash value. B. It pays dividends to the policy owner. C. It is sold only by mutual insurance companies. D. Its premiums are typically lower than non-participating policies. Answer: B. It pays dividends to the policy owner. A participating life insurance policy allows the policy owner to participate in the insurer's divisible surplus through the payment of dividends. Dividends are essentially a return of excess premium and are not guaranteed, but they are paid out when the insurer's actual mortality, expense, and investment experience is more favorable than projected. These policies are often sold by mutual insurance companies but can also be offered by stock companies. The ability to receive dividends is the defining characteristic. Question 18. Under Kansas law, which of the following describes an annuity? A. A policy that pays a lump sum upon death. B. A contract that liquidates an estate by paying a series of payments. C. A policy designed primarily to provide a death benefit. D. A short-term savings vehicle with no tax benefits. Answer: B. A contract that liquidates an estate by paying a series of payments. An annuity is fundamentally a contract designed to provide a stream of periodic payments to an individual, typically for life or for a specified period, in exchange for a lump sum or series of premium payments. Its primary purpose is to liquidate an estate or accumulated funds over time, protecting against the risk of outliving one's savings, rather than providing a death benefit like life insurance. Think of an annuity as the opposite of life insurance. Life insurance creates an estate, while an annuity liquidates it. Question 19. A producer in Kansas replaces an existing life insurance policy without advising the client of the potential disadvantages of losing the incontestability period and new suicide clause. This could be considered: A. Conservation. B. Churning. C. Twisting. D. Rebating. Answer: C. Twisting. Twisting is an illegal act where a producer persuades a policy owner to lapse or surrender an existing life insurance policy and replace it with a new one to the insured's detriment, often without fully explaining the disadvantages of the replacement. Losing benefits like a settled incontestability period, a favorable original issue age, or having a new suicide clause activated are significant disadvantages of replacement. This practice is prohibited to protect consumers from unnecessary policy changes that primarily benefit the producer through new commissions. Question 20. In Kansas, when must a life insurance policy's entire contract clause be present? A. Only in policies with cash value. B. Only if the policy is convertible. C. In all individual life insurance policies. D. It is optional for the insurer. Answer: C. In all individual life insurance policies. The entire contract clause is a mandatory provision in all individual life insurance policies in Kansas, as it is in most states. This clause stipulates that the policy document itself, along with the application, if attached, constitutes the entire agreement between the policy owner and the insurer. It prevents either party from referring to outside documents to interpret the contract, ensuring that everything relevant to the agreement is contained within the policy, protecting both the insurer and the insured from future disputes. Question 21. Which of the following is a common method for calculating the amount of a policy loan in Kansas? A. A percentage of the policy's face amount. B. The full accumulated cash value of the policy. C. A fixed percentage of the premiums paid. D. The policy's cash value minus any outstanding loans or unpaid premiums. Answer: D. The policy's cash value minus any outstanding loans or unpaid premiums. A policy loan is a privilege that allows a policy owner to borrow money against the accumulated cash value of their whole life insurance policy. The maximum amount available for a loan is typically the policy's accumulated cash value, less any existing policy loans or outstanding unpaid premiums. Interest is charged on the loan, and if the loan and accrued interest exceed the cash value, the policy can lapse. The loan does not need to be repaid, but it will reduce the death benefit paid to beneficiaries if not repaid before the insured's death. Question 22. Which type of life insurance policy is characterized by flexible premiums and adjustable death benefits? A. Whole life. B. Term life. C. Universal life. D. Endowment policy. Answer: C. Universal life. Universal life insurance is a type of permanent life insurance characterized by its flexibility. Policy owners can adjust their premium payments within certain limits and can also increase or decrease the death benefit, subject to underwriting. This flexibility allows the policy to adapt to changing financial needs throughout the policy owner's life, unlike the fixed premiums and death benefits of traditional whole life or the temporary nature of term life. Question 23. A Kansas resident wants to purchase a single premium immediate annuity, SPIA. When will the income payments for this annuity begin? A. After a deferral period of at least 1 year. B. Immediately or within one payment period from the date of purchase. C. Only upon retirement of the annuitant. D. Only after the annuitant reaches age 65. Answer: B. Immediately or within one payment period from the date of purchase. A single premium immediate annuity, SPIA, is designed to begin providing income payments right away, usually within one payment period, e.g., a month or a quarter, after the lump sum premium is paid. This is in contrast to a deferred annuity, where payments begin at a future date. SPIAs are often chosen by individuals who are retired or nearing retirement and want to convert a lump sum of money into a guaranteed income stream. Question 24. What is the primary purpose of the National Association of Insurance Commissioners, NAIC? A. To regulate the insurance industry at the federal level. B. To develop model laws and regulations for states to adopt. C. To act as an insurance company rating agency. D. To resolve consumer complaints against insurance companies. Answer: B. To develop model laws and regulations for states to adopt. The National Association of Insurance Commissioners, NAIC, is an organization of insurance regulators from all 50 states, the District of Columbia, and U.S. territories. Its primary purpose is to develop model laws and regulations for states to consider adopting, promoting uniformity and consistency across state insurance regulation. While the NAIC does not have direct regulatory authority, its model laws are highly influential, helping states like Kansas implement effective consumer protection and solvency standards. Question 25. Which of the following statements is true regarding a life insurance policy's cash value in Kansas? A. It is guaranteed to grow at a fixed interest rate in all permanent policies. B. It is generally not accessible to the policy owner until the policy matures. C. It can be used as collateral for a loan or surrendered for its value. D. It is the same as the policy's face amount. Answer: C. It can be used as collateral for a loan or surrendered for its value. The cash value component of a permanent life insurance policy, such as whole life or universal life, represents the savings element that grows over time on a tax-deferred basis. This accumulated cash value is a valuable asset to the policy owner. It can be accessed in several ways: by taking a policy loan against it, which reduces the death benefit if not repaid, or by surrendering the policy for its net cash value, which terminates the coverage.